So let's begin. So as we start, we're here for what we call the RMD, or Required Minimum Distribution and Taxes webinar. This is one of the more popular webinars that I actually do. You'll see me over here. That's Mike. If you see me in the right-hand column, you can push the screen aside if you like to maximize the presentation. That works as well. So as we begin, you'll see that I'd like to start with really a basic question here. Let's see, whoops, I'm going to hit myself. What do you think that RMDs and taxes have in common? And what is the relationship to your retirement as well? So we're going to take a look at that this evening. And as we do, I think you'll discover some things that you may not have understood before about RMDs. So this is me. I am your speaker tonight. This is Michael Holt. So I appreciate you being here. And just a note on this screen before I go back, stick around. There's some free guides at the end of the webinar I want to share with you. So very good. All right. And here we go. A little bit about myself in case you want to know who's speaking to you this evening. I graduated from ASU, got a couple degrees. I've been in the business almost 24 years now. I worked for a lot of Fortune 50 companies in my younger days. And then I started this company with a number of people about 22 years ago. One of the things I do a lot of is speaking on different topics. Obviously, this is one of them. And I actually publish a newsletter. And of course, you can see in red what I hold myself out to be as an expert in. So hopefully that helps you kind of understand where I'm coming from as well. So if I pause just a second, that's because I'm letting people in the room. So let's get started tonight. And sometimes I get asked this question, why am I in this business? And I just want to take a minute of your time to let you know, years ago when I was actually still in college, unfortunately, I had about 6 aunts who all lost their husbands fairly quickly within a matter of 4 or 5 years. It was devastating. The thing about it was they were all left scrambling to understand their retirement. They got taken advantage of. They really didn't get good advice. And I'm like, I want to put a stop to this. So that was one of the inspirations for me actually starting this company, to build a more credible to come and learn. There's no strings attached. It's all educational. I just want people to understand more about their retirement. So that's really why I got involved and why I stay involved today as well. So with that in mind, I want to go ahead and start the actual part of the meeting, which I think you came here for. And a lot of people, generally speaking, RMDs, and we're going to cover these tonight. One is, what is it? And how do I use it? It's relatively simple, and you really don't need any expert advice to do that. And I'll show you as we go. Ask is, how do I gauge the taxes on my RMDs? There are taxes, right? There's always taxes. So that too, how can I save taxes? That means maybe now or in the future, what can I do to save taxes? And how are the beneficiary designations different from other accounts? And they are, and that's some people. And here's a good one that I often bring out with my clients, and they ask, do I have enough guaranteed income without stress, fear, or worry? There's not many sources of guaranteed income, and we're going to touch on some of those this evening. So that's going to start our evening tonight. For RMDs, and why did they exist in the first place? I get that question sometimes. Well, let's look at where it began. You started in what we call the accumulation stage. Obviously, you went to work, you put money in, so you saved, and that's great. That's what you wanted to do, and Uncle Sam wanted you to do that too, right? You saved in these qualified plans like these. 401ks, 403bs, IRAs, etc., did a great job. Seniors and boomers did a wonderful job of saving. You were able to defer those taxes, right, on the principal during the accumulation phase. You didn't pay any taxes yet on that money. It simply was there growing for a future date. That's great. Now you're approaching or you're in retirement. That's great too. But what if your qualified funds now have a very large tax liability that's due to not so great, right? So what do we do about that? So you're entering what I call, and a lot of advisors call, the distribution stage, or really the retirement stage where you start to live off your assets. And will there be enough? And how do RMDs impact that? We're going to take a look at that a little bit in depth tonight. So, in summary, RMDs are called required minimum distributions that must come out of those types of accounts. So the government wanted you to save and you save for retirement. Now the IRS wants their cut, right? And they want it quicker than they used to. Thus, RMDs must be withdrawn. And I say must because if you don't, there's actually a 25% tax liability. It's really a penalty that's attached to the RMD. You still have to take your RMD, but the IRS will actually bill you for the 25% if you don't take it on time. Now, a lot of the companies you probably deal with where your money is already have a plan in place, but not all of them. So I would definitely check that out. Now, one of the things I want to share tonight is there were some big changes to RMDs that maybe a lot of people are not aware of. One, it became apparent through Secure Act 1.0, and that was actually impactful to some point. But it was actually Secure Act 2.0 that did the following, so actually be relevant to you. The penalty was actually decreased to 25% from that. That's a big change. For years, it was always 50%. So they loosened up a little bit. Another thing that might impact you, it just depends, but Roth accounts are no longer required in retirement, employer retirement plans as of 2024. That used to be there. That's no longer there. And another thing, if you're having an in-plan annuity payment, like it's in your plan already from your employer, it used to be that whatever you withdrew from that annuity was just that. It didn't count all towards your RMD. So the excess amount now, if you withdraw more than's required, it actually applies to the following year. So that could be very helpful to some people. And here's the biggie. This is what impacts all of us. Starting now this year, if you're turning 73 in this year, you have until December 31st of this year to take your first RMD. But you could delay that until April 1st of next year. But if you do, you'll have two RMDs in 1 year. I don't think anyone wants that, right? You're probably better off taking the RMD this year, getting it done, and then taking the next one next year so you don't stack them up. But you could if you have a reason to do that. So those are just some of the changes I wanted to share this evening. Now, let's talk about this first. How do I even calculate my RMDs? I kind of know what they are now, but how do I calculate them? So we're going to be using something called the IRS Uniform Table. This is a simple table, and you can get it from the IRS. You'll find it on a lot of websites as well. Basically, what this is doing is offering you a distribution period as a divisor. And we'll look at that in a moment in a formula. But you take your age, in this case, let's say we're 73. If you notice the arrow there, it says distribution period is 26.5. Basically, it's a nice way of the IRS saying, well, that's your life expectancy, basically. That's generalized. It's always varies, between age and obviously health and all that. But they're claiming this is IRS now. This is not insurance company saying you've got a distribution phase of 26.5 years. Now, keep that in mind. And we're going to actually look at an example here. So here's the formula. Pretty simple. Basically, you take the balance of your December 31st account. So you have to go back to the last December. We are here in July. So go back to December 31st, 2025. And whatever that balance was, write that down because that's the one the IRS is going to use. Now, take that life expectancy or that factor we just looked at, and you actually divide it into your IRA qualified money. So it works like this. Let's say you had $100,000 in an IRA. You're 73, so we know the factor is 26.5, right? From the table. You divide that into the 100,000, that says you owe the government of RMD distribution of $3,733.58. That's what you have to prove that you're going to take out of your qualified account. If you don't, you take more, it's great, that's fine. But if you take less, that's where that penalty could come into play. So remember, that's the basic formula. So here's a note about this so-called uniform lifetime table. It actually decreases over time. So as you notice that it could go from set 26.5 if you make it age 74, 24, 25.5, and so on. So it's really just a divisor. And the formula here on the left-hand side is pretty simple. I think most people could do that. I would suggest doing that on every one of your accounts so you know exactly where you stand. And it's the qualified accounts, not cash or anything in money markets unless it's qualified. So the formula in this case, I use the example, really applies to an unmarried owner of an IRA. If you are married or your spouse is more than 10 years, not more than 10 years younger, you're going to have a different table. But that's on the IRS website too. So the table I used was just an example of an unmarried IRA owner, but at least it gives you the formula. So hopefully that helps. The next thing we're going to look at is what I call really not understanding how RMDs work with your 401ks, 403bs, 457s, and IRAs. Let's take a look at this because this really trips people up sometimes. We're going to use an example. Let's say we got another 73-year-old. They have $1 million in savings, just generally speaking. Let's say they have two IRAs with 250,000 each, as you see on the screen. So they've got half their money, 500,000 in two IRAs. So we know from that formula, if we take the 500 and divide it by 26.5, that's 13,250 that's going to have to come out of those accounts to meet the required minimum distribution. Now, the IRS looks at this differently than maybe you do. It looks at all your IRAs as one account. Now you say, well, I have several accounts. That's okay. But the IRS says, we don't care. We what is your total IRA balance? That's what they're after. So you really could take the 13,250 all from one account, or you could divide it like this, or part from one and part from another, and every year it could be different. So the IRS doesn't care when it comes to IRAs. But note this, the other qualified funds, let's say you have 500,000 over here on this bucket too, but 250 is in a 403b and 250,000 is in a 401k. Now, can you take a lump sum from one or the other of these accounts? No, they cannot be combined. They must be taken from each. So, in other words, there's a firewall here. So, you cannot treat it like you treat IRAs. They look at these individually. Even if you have multiple 403bs, they'll want to see that come out of each of those accounts. So it can get a little tricky, right? Because if you're managing 6 or 7 or 8 accounts, and I've seen that with clients, sometimes they miss an RMD. You really can't commingle. Left side, okay. Right side, not okay. Here's a tip. This is what is simplify your life. If you got 403bs, 401ks, a leftover 457, couple IRAs, actually it may be to your benefit to combine all those and move them to an IRA. You can do that. You can actually move those types of accounts on the right-hand side into an IRA, and you control it. Think about this. If you leave it in a 403b or 401k, you got three players. You got yourself, you got the company as their rules and regulations, then you got Uncle Sam. If you move it to an IRA, you only have two players. So that might help a little bit. Now, there may be reasons to keep some money in these accounts. Obviously, that's just a general rule of thumb. But a lot of people do like to simplify their lives in retirement. So hopefully that helps. Now, the accounts again that can be taken must be taken separately, just to reiterate, are all those other accounts. The only ones that can be combined are IRAs. So hopefully you got that, if anything else tonight. So good deal. Does taxes work? That's the next big question I get with RMDs. Let's take a look at that. So here's the basic question. RMDs are 100% taxable as ordinary income. There is no capital gains tax from the IRS as 100% taxable against your ordinary income rate. exception would be if there's non-deductible or after-tax contributions you put into an account and that could be adjusted. But for 99% of us, it's item number one. 100% of that RMD is going to be subjected to ordinary income tax. So sorry, no capital gains in this case. Now, let me illustrate something else. Think about this. How much extra tax liability is your RMD going to create for you? So as you see in the white here, it depends on your marginal tax bracket, which basically, if you look at this 2026 table, I'm only showing single filers and married just to keep it simple. I left out a household and all the other categories off. But let's say you're single and you're making $50,000 a year. Well, if you look at the chart, you go to the left, you're in the 12% tax bracket. But let's say you're now taking your RMD as a retirement and that jumps to 65,000 a year. Well, now you've jumped up to another tax bracket, right? So part of your income is going to be taxed at 22%. So if you keep that in mind, then you may be able to better structure your taxes when it does come due. You won't be so surprised when the RMD hits your tax return. So good deal. Now, another two things I want to cover. What other taxation could be affected by this? And there are two that I just want to touch on briefly tonight, because people sometimes miss this as well. One of them is Social Security. Now, depending on where you are right now, with or about to draw or sometime away, it's good to know this because your RMD will affect your income and your tax rate. Now, this table is just a simple one that says filing status. The next column is provisional income and the amount. Let's take an example. Let's say you're married and your provisional income is on the next screen. So keep that in mind. So your provisional income is $34,000 between the two of you. If you go to the right-hand side, well, then up to 50% of your Social Security could be taxed. Now the RMD comes along, right? So now you're married filing jointly, and now you're making $50,000 a year. Up to 85% of your Social Security is now subject to taxation. Now, these numbers are low. It doesn't seem like it may be too difficult to hit those numbers, right? So let's take a look at exactly how that works. So looks like I'm breaking up a little bit. My apologies. I'll try to watch that. So if we take a look at the next screen, this is the actual calculation that you'll need to know. So if you take your AGI right off your tax return, that's the adjusted gross income, you add back your tax exempt interest, which you got to deduct, and then you add half your Social Security benefit. That's the formula Social Security uses. That's nothing to do with the IRS, right? That's Social Security. So if the total is over 25 for single or 32 for married, then up to half of your Social Security can be taxed. If it's below that threshold, your benefits are tax free. If it's over 34 or 44K for married, up to 5% of your Social Security could be taxed. If it's not taxed already, your RMD could put you in that category. So that's the formula, basically. Now, one other thing I'll mention, which maybe you've not heard of, is IRMA. It's what we call it, IRRMA. It's a Medicare surcharge. And basically it's for income-related monthly adjustment amount. It's a fancy way of saying it's another penalty. What happens is people who have high incomes could be impacted by this. So depending, it could change the premium for your Medicare Part D and B as well. It affects some individuals with higher incomes if you're above certain thresholds, and that is determined in this case just by your modified adjusted gross income. Let me take a look at this in an example that might make it easier. So right now, Part B, the drug plan is whatever your premium is that you chose, right? That's pretty standard. Well, just like Medicare, we'll look back 2 years to determine. Here's the IRMA table for 2026. Again, it's for high income earners, just in case there's some on the call. So spend single, you're making 100,000 in retirement, side, there's no impact on Part B or Part D. But let's say you're actually now taking these, and now you're making 120,000 a year in retirement. Well, you go down to the table and go across. In this case, they're going to add $81 to your Part B, and they're going to add $14.50 to your Part D. Now, again, the key is it's a look back for 2 years. So if you start RMDs this year, they may not impact you for 2 years. So again, this is really for high income earners, but it could affect you. So good. Now, if some of you need to go or jump off the call, no problem. What I would like to suggest is if you want to talk further about these things, there is my calendar on the screen. I'm actually going to put that in the chat early just in case you guys need to jump off. I'm going to do that real quick because I'm getting some response. So let's see here. In this way, you can get on my calendar and we can talk about anything. It doesn't actually have to be these subjects as well. Under invitation in the chat. So, and now we'll continue on with our meeting here. So, next subject. Let's talk about the assets that you have allocated right now for your retirement. And the question I have, and you might really want to seriously consider this, I don't know if you've been asked this before, but are your assets allocated properly for RMD distribution? Now, what does that mean? Well, thinking ideally, in an ideal world, right? The interest or dividends that you would earn on your investments would satisfy your RMDs with no impact on principal, right? That's ideal. Can we do that? You know, the chances are slim that we get that exactly right, but we can come close to that with some of these strategies. And that's what I want to share with you. So the reason I say this is what you need to know. And this is what I tell Mike about. You really can't use the same strategy you did to accumulate the funds to deaccumulate funds and start distributions. Now, why is that? Because we don't have enough time left in the market, not in the market, but time in the market to taking income. So some of the clients that I met early on, you know, they were in this situation. The market's down and they're taking income out. That's like a double whammy, right? So you're eating up your principal much faster. Let me give you one example, and I don't want to bore you with too many charts, but this one's pretty revealing. This chart is saying if you go on to the left-hand column, in this here, let's say 30%, it goes down 30%. If you go to the right-hand column, what would be required for the market to do just to break even? So if it's down 30 and you go across 4%, that's just to break even. You don't really gain anything. So you can see why I say be very careful that the strategy you're using now for distributions isn't the same as accumulation, because then you had years to write out a loss. Now you probably don't have as much time. So that's why it's really important to understand that you might want to have a little more protection on your account. So now let me illustrate this. This is what most people do. We call it the withdrawal method. It's a little re-engineered kind of scenario here, but it's actual numbers. So I don't want you to get carried away with this. These are actual numbers. Let's say you had $1 million again. You wanted to take out 40,000 a year. That's your cash flow. That's CF. I just want 40. That's what I want out of my retirement. So if you look at the dates from January 2000 to January 2010, you started with the $1 million, right? But the market was down 9.10% that year, and you still took 40 out. So you ended up with 861. All right. And then we go along and we see these negative years in the first part of your retirement, down 11, down 22, down 37. And these are actual numbers. So from 2000 to 2010, you could have reduced your $1 million to like $378,000. I actually had a client from HP who retired at 55 with a little over $1 million in his IRA. When he came to see me through one of my seminars, his wife walked the door with tears. I'm like, this is not going to go well. And he was really upset. He experienced this exact scenario. In fact, he had less than 300,000. So we had to help him fix that problem. by eliminating some of the risks. So I call this the if come method because you don't know if you're going to have enough income under this method. So is there a better option or a better way? And that's kind of what I wanted to share with you next is, well, there is. Now, we call this the restructured income, retirement income option, and I call it income instead of if come. Same scenario. Let's say you started in January, $1 million, you wanted 4% basically out, and that's 33 a month. That's just another way of saying 40,000. Wouldn't it be great, ideal, if you could earn enough throughout your retirement? Chances are slim that you do that, but we have strategies that get you as possible to this exact scenario, so at least you won't run out of money. So I call that the income method. So we structure it also to meet the RMDs. We're always going to make sure you take out enough for your RMDs as well. So other things to consider why you might want to look at this method rather than the IFCOM. Think about these things, the last recessions, the Strait of Hormuz. Look at that. Middle East, we're still in the turmoil of that. What is the Fed's going to do with the interest rates? What about China? What about the Trump tax cuts? Are they going to hold? So all these things factor into retirement, which you may never really wanted to think about before, but now you're kind of forced to think about, right? My question to you this evening is, what is your plan for income, your asset allocation, your tax strategy, and why is that your plan? So again, I always ask my clients, do you like the if come method, which places a lot more pressure on your savings and qualified money? And it's really not positioned to avoid market losses, or do you like the income method, where we can help you avoid market losses and guaranteed income for life for growth, even a lot of times without fees? Now, I wouldn't suggest taking all your money and using this strategy, but it really doesn't take a lot to boost your income and have some guaranteed growth and income at the same time. So, which of these methods, obviously, do you prefer with your retirement funds? Now, what about we flip the coin to kind of start wrapping things up? What if you don't need your money? What if you don't want the RMD, but you still have to take it, right? Because the government says if you don't, there's a penalty. Well, obviously, you can spend it. You can go on vacation, you can save it, you can gift it. Some clients even buy life insurance because they like the tax deductibility of life insurance, and you can still pass it on to your heirs. There are some nice things about life insurance, but it may not fit you. So, what are the real RMD options for a lot of us? Well, I'm going to share two strategies with you tonight. One of them you probably have heard of is a Roth conversion. Now, we're not going to turn this into a Roth conversion webinar, but I do want to touch on a couple points there. Another one is what we call the RMD guarantee strategy. That's probably something you haven't heard of. So I'm just going to touch base on these so we kind of know what this means. So a Roth conversion is basically the process of taking your qualified money and moving it into a Roth IRA that basically paying the tax up front. And this is around, it's gained a lot of traction in the last few years, obviously, because people like eliminating their tax bill, right? Well, the key difference, obviously, is tax deferred, you will pay taxes when you withdraw the money. But the Roth has the potential to grow tax free, and your withdrawals would be tax free, but you have to pay the tax. You pay taxes now to enjoy more tax free income in the future. Another point for you, the IRS obviously is in control of taxes, not you and not me. So why not take as much control of your tax liability as possible, right? That makes sense. But we don't know if a Roth conversion is for you. But however, there are 6 reasons I always say consider it. And these are the 6 as a recap. It's a tax-free retirement and income and savings. There's no RMDs anymore. Once it's converted, there will be no RMDs coming out of a Roth. You can hedge your future tax increases because you can lock in today's rate. They are low. Doesn't seem like it, but they're low compared to history. You can reduce maybe potential taxation on your Social Security. We talked about IRMA, and obviously it's a tax-free legacy to your beneficiaries. Those are the real main reasons people want to do it. That's not all. So is it right for you? We don't know. It really isn't right for everyone, but to me, it's at least worth looking at. So as I said, taxes are on sale Would it make sense to pay taxes now and reduce a larger problem later on or not? We happen to be certified Roth conversion specialists. There's only a few of us in the country that have that title. So we use the most extensive software we can in the marketplace. And basically, it's not that difficult to return a report to you that says, okay, if you do this, does it make sense? And here's how we judge making sense, financial sense. Is your portfolio going to be to do a conversion or not? It's great to eliminate taxes and RMDs, but is it worth paying the taxes up front? That's what we need to answer. And that's what we do for our clients. And then they make the decision whether or not they want to proceed. Now, the next one I'm not going to spend a lot of time on because it gets kind of involved. But basically, the RMD guarantee strategy works like this. And it's actually more for your beneficiaries, but it's for you too. So this strategy says, okay, I don't really want to do a Roth, but I have to take my RMDs, I'll take them and I'll pay the taxes. I'm going to go ahead and settle on that. But you can obviously spend that RMD any way you want. Like I said, all those other options were on the screen. But this strategy guarantees to leave more to your beneficiaries than you started with, even if the market goes down 10 years in a row. So we have a lot of clients interested in this strategy because they get to take their RMD. I mean, you work for it, you deserve it, take it and enjoy it. But they still want to leave something to the heirs. And the way to do that is the RMD guarantee strategy, where you can pass on at least what you have or more to your beneficiaries. So we call that the RMD guarantee strategy. If you want to know more about that, let me know. You can always actually sign up for an appointment. We can talk about it and see if it fits you. So anyway, now, before we leave beneficiaries, I want to make sure you know this too, because this confuses a lot of people. The way it's set up now for most accounts, your spouse, as a sole beneficiary, can roll their entire IRA you can roll it into his or hers after you pass. But only your spouse has that option. People think anyone could do that. No, it's either got to remain in his or her name that passed or your name, but only for your spouse. So the general rule for non-spousal beneficiaries of these types of accounts is that the entire IRA has to be distributed to your beneficiaries within 5 years. That means they need to empty the account. However, the Secure Act changed that. Now I'm going to use the word stretch. We can stretch that distribution out for 10 years, but it's for a non-spouse. Spouse has more options, obviously, but now a non-spouse can wait up to 10 years. There's legislation on the book that says the IRS is upset. They don't want to wait 10 years for that. So we may start seeing some requirements to withdraw that sooner, but have to empty 10 years. Stay tuned. We'll see what happens there. But consider this. I mean, there's tax consequences whatever way you go with this. So leaving that money to someone else will eventually create another tax problem for them, or it's going to be your tax problem to actually assess right now while you have an option. So that still doesn't change the taxation. One last thing, people get confused on this too, and I want so I want you to take, because beneficiaries are left either per capita or per stirpes, and basically on the left hand side, per capita, just you have 3 children and one passes, the money then would be divided to the remaining 2 children. The third would get nothing in their heirs. But per stirpes is the opposite. It's like following the bloodline or by class. So if you have 3 children, one passes, that deceased child still gets their share and it goes to their estate. So either per capita or per stirpes. That's how you look at beneficiaries as well. So hopefully that makes sense. So one last thing before we wrap up. Here's another option. So we've talked about whether you need it or not and what you can do to reduce taxes, but do you need it actually for income to meet your retirement goals? Are you really counting on that money to come through to meet your day-to-day expenses? Maybe you have Social Security, a small pension, but it's not enough. So I've got clients like that as well. How do you actually cover that? Well, the critical retirement questions are these. Ask yourself, do you have enough guaranteed income to live in your retirement without stress, fear, or worry? And it's not just income, in any income, it's guaranteed income. That's the key. The other question is, what would happen if you ran out of money? I'm sure some of you have thought about that. It crosses about 48% of retirees' minds. That's according to stats. There are guaranteed income accounts that you can use with your qualified money to make sure you never run out of money, no matter how long you live. And what you don't use is passed on to your beneficiary. Let me give you an example of some of the clients that we've helped. We won't go into all the details, but here's a couple. They were age 60 and 62. They needed immediate income. They put in 420. We got them 2387 in guaranteed monthly income for life. So over the life expectancy, that account paid over $770,000. If you look at the male, age 58, he came early to me and says, I want to retire in 10 years. I got 155,000. What can I do for guaranteed income? So in 10 years, we're going to start him at 2177. He'll collect over $500,000 in guaranteed income. Look at the last one, which I think is really great. The female, 62. She wants to retire in 5 years because that's when her Social Security starts. She had over $1 million. We took 380 of it, just 380. We actually put it into a guaranteed account. We got her 3188 a month. She'll collect almost $900,000 over her life expectancy. Pretty good, right? So our guaranteed income plans really, we help people increase their guaranteed retirement income somewhere between 50 and 30% compared to a lot of other strategies. So if this interests you, let me know. Because here's the rule of thumb I always teach my clients is make sure you've got enough guaranteed income coming in to at least cover your bills and maybe a little bit more. Because you want to wake up the morning stress free. You don't want to think, well, do I even have enough to cover my basic bills? That's one thing I always say. The other rule is what if you really could have steady income for the remainder of your life, regardless of market conditions, inflation, wars, financial crisis, interest rates? How would that make you feel? And a lot of my clients like, yeah, I retired, I worked hard, I don't want to risk anything. I want to have some peace in mind, right? So what I want to do now is actually give you a freebie. This is one of the things I talked about. We have a guaranteed income planning guide. And if you look in the chat, I'm going to actually post that guide. And it will help you kind of understand what guaranteed income is all about. Read it. If you got any questions, you can always let me know. Let's post that there. It's an easy read, and it will give you some insights on how to look at this guaranteed income planning for your retirement plan. So one freebie. So as we wrap up, the last thing I want to kind of share with you, this screen. Wouldn't that be nice? Isn't that the dream? Just to live without stress or worry or fear and running out of money. And that's really what we help our clients do first and foremost. So as we wrap up tonight in the recap, remember we talked about RMDs and how to calculate the RMD amounts. We talked about why you need to take the RMD and using the principle of separate accounts when necessary. We talked about taxes and how they're affected. It may actually affect Social Security and Medicare. We talked about the income method versus the income method, a little bit more security there. The two strategies we covered for RMDs is Roth conversions, which may actually be to your benefit and actually improve your portfolio. And then the RMD guarantee strategy, which helps you. You take your RMDs, but it definitely leaves more to beneficiaries. Talk about beneficiary management. That's why I always suggest check your forms, make sure everything's in good order. And then we talked about ensuring guaranteed income to meet your retirement goals. So basically, that's the webinar this evening. But one more free gift, because I didn't really want to dive into this too much, but I'm getting a lot of questions and concerns about long-term care. We've been actually offering that for 20 years. I'm going to put another free guide into the chat box, and that way, if you'd like to take advantage of that as well, you're more than welcome to download that. I said it's an easy read that will help you understand even more about long-term care. And let's put that in the chat box. There we go. So now you have that as well. So you guys so much for attending. I really appreciate your attendance. And hopefully you've learned some things that will really help in your retirement. Oh, I think I went back on the screen. There is my actual calendar. Got that link. It's already in the chat. I'll put it in there again and I'll leave it up on the following screen. And you can always reach out to me on my cell. If you don't want to use Calendly, that's fine as well, because I know some people really don't like doing that. So that's fine with me. There is my Calendly there again in the chat box. So there we go. So I appreciate your attendance tonight. Hopefully you've learned some things, and I hope you have a great evening. I'm going to leave the screen up for just a few minutes, and there's my Calendly on the screen as well. Thank you guys for attending, and have a wonderful evening. Take care. Bye-bye. Bye. Thanks.